Coming now to section 8, which is the final section of this reading, and this is a little bit complicated, but this material is covered in detail in other topics also. So what we'll do is talk about this material at a high level, make sure we get the concept, and then later on when you see this in equity, for example, then it will make a lot more sense. The larger point is this, that capital budgeting was one of the first widespread applications of discounted cash flow analysis, and most of this reading has been based on your fundamental or basic capital budgeting model, where you project cash flows and then discount cash flows and effectively use NPV to decide what to do, what not to do. But there are other related methods. And in the context of other methods, we'll talk about the distinction between economic and accounting income. And then we'll also talk about deciding on projects, what to do, what not to do based on economic profit, residual income, and claims valuation. This connects with level 1 economics as well as with level 2 equity. First, just a quick recap of your basic capital budgeting model. We are given a scenario in the curriculum. I'll not go through the details again, but the idea is that there is a certain investment. You project your operating cash flows, you project your non-operating cash flows at the end, and then you come up with an NPV and IRR and decide whether to do the project or not do the project. Fairly straightforward. Section 8.2 deals with the distinction between economic and accounting income. What is accounting income? This is the income that you come up with using your standard accounting procedure. You might have a depreciation number. Is that depreciation based on the real economic change in value of your asset or project, or is it based on some accounting rules? It is actually based on accounting rules. When we talk about economic something or another, then we move away from accounting rules and look at what is actually happening, what is the economic reality. So learn this definition. Once you understand the concept, it is fairly intuitive. The economic income from a project is equal to the cash flow that is generated in a given period. So if you have period 1, and in period 1, the cash flow generated is 100. And the market value of this project was initially 50, but the market value at the end of the period was 30. This is the economic value of your overall project. The economic income is equal to the cash flow, which is 100, the real cash flow, plus the change in market value. What's the change in market value? That is minus 20. So 100 minus 20 is 80. So your economic income is 80. That is economic income. The other way of expressing the same concept is to say cash flow, which is 100, minus economic depreciation. Economic depreciation in our example is 20. This is the actual economic depreciation. What do we mean by economic depreciation? It is the change in market value. But the subtle distinction here is when we talk about depreciation, if the market value went from 50 to 30, then the depreciation is 20. So these two are just exactly the same formula, just the plus minus is different because whenever we say change in value, it is end value minus beginning value. When we say depreciation, it is beginning value minus end value. So it is the same formula. You can pick which one you prefer and use it. Why is accounting income different from economic income? The big reason is that accounting depreciation is based on original cost and accounting rules, whereas economic depreciation is based on actual market values. The other point is that accounting income considers interest expense, whereas economic income does not. This is a scenario from the curriculum which has somewhat complicated numbers, but the concept is exactly what I talked about. What is the economic income for year 1? How do you do this? You look at the after-tax cash flows and you look at the change in market value. So this is the beginning market value, end market value, Market value went down by 23,051. So how do you come up with this economic income? It's the cash flow minus this number. So bottom line, what is economic income? It is the cash flow, and then you adjust that cash flow based on the change in economic value of the project. Then we come to section 8.3, which is the last section. Here we'll talk about economic profit, residual income, and claims valuation. Economic profit is something that you saw at level 1 economics. Residual income is something that you'll see in a lot of detail in equity, but I'll just touch on them very briefly. Okay, let's talk about economic profit. Economic profit takes the perspective of all investors, debt investors and equity investors. And here is the formula for economic profit. It's NOPAT, which is the net operating profit after taxes. In some readings, in some textbooks, this is written as NOPLAT, where the L stands for less adjusted taxes, but the two mean the same thing. So NOPAT stands for the money that is generated, which is available to debt holders and equity holders, minus the interest. So how do you calculate it? EBIT, which is the overall operating profit, and then 1 minus the tax rate to pull out the tax. And then dollar WACC, this is simply the cost of capital, which is a rate, multiplied by the total capital which has been invested by both the debt holders and equity holders. So roughly speaking, this will be the total operating assets, the net operating assets. Now here again, fairly straightforward calculations. If you are given this information, let's consider year 1. How do you come up with the economic profit for year 1? We use this formula. What's NOPAT? You are given EBIT of 25,000. You are given a tax rate of 40%. So given EBIT and given the tax rate, you can come up with NOPAT of 15,000. How do you come up with dollar WACC? You are given that capital is 150,000. You are given that cost of capital is 10%. So you multiply and you come up with dollar WACC is 150,000, and you take the difference and you get 0. I want to make sure that you also understand the concept over here. If you think about an investor perspective, what does 10% represent? The WACC. This represents the cost of capital. How much capital has been employed or used over here? That number is 150,000. In dollar terms, what is the cost of raising this much money? It is 10% the cost of capital times the amount of money that has been raised. So the cost of raising this much money is 15,000. And what is the amount of money that is being generated from this investment? That money is also 15,000. So even though in accounting terms you might say that, look, we generated 15,000, but in economic terms, when you consider your opportunity cost, when you consider the fact that you have to spend 15,000 to raise this capital, the economic profit is actually 0. Economically speaking, you actually make money when the cost of raising money is less than the money that is generated from your project. And that happens in year 2, where NOPAT is 30,000, that's how much is generated. The dollar WACC is 12,000, so the economic profit is 18,000. Then how do we come up with the overall value of this project? We come up with the NPV or value by looking at all the economic profit numbers and discounting them back. And the term used for this is market value add, because here we are actually looking every year how much value is added above the cost. Residual income is something similar, but here we are taking equity perspective alone. So what is residual income? It is net income. Who gets net income? It is the equity holders. But does this income come for free, or is there a cost? There is actually a cost called the equity charge. What is that cost? If you take a given period, during this period there will be a certain net income. That's what you as equity holders are getting. But what is the opportunity cost? What is the charge associated with getting this income? It is the cost of equity multiplied by the value of your investment at the start of the period. So if this is time t, this can be time t minus 1. What is that value? It's book value of your investment at time t minus 1. So that's what is shown over here. Your residual income is positive if the net income for a given period is larger than the equity charge. Conceptually, this is similar to what we talked about on the previous slide. Only difference is that on the previous slide, we took the overall investor perspective that included debt and equity holders. Here we are only taking the equity holder perspective. That's why we use the cost of equity alone over here. Previously, we used the cost of capital, which combines both the cost of debt and cost of equity. Now, this is a simple illustration. In year one, if this is the net income, this is the equity charge, then this is the residual income. The story looks good here because throughout the residual income is positive. How do you find the NPV of this project? You simply take all the residual incomes and discount back at the cost of equity. That is the fundamental point over here. If you look at this calculation, all this is saying is that the present value of residual income is telling you that based on the residual income that will be generated in the future, what is the value? You can add that to your existing equity investment and add that to the value of debt. That will give you the total value. And final point, claims valuation. Again, I don't think this is overly testable, just you need to know what this is. Everything that we've discussed in this reading is based on assets. We look at assets, we look at what will be generated, and then we come up effectively with the present value of some numbers, be it the actual cash flow or the residual value or whatever. But generally the focus has been on the left side of the balance sheet. What claims valuation does is focus on the right side of the balance sheet. And it says that, look, one way of coming up with the value of assets is to come up with the total value of liabilities and total value of equity. If you add the two numbers, then you will have the value of assets. And the reason this is called claims valuation is because liability or debt holders and equity holders have a claim against the assets. So value the claims and you automatically have the value of assets. So how can you do this? There are many different ways, but the most simplistic approach would be to say, okay, find the present value of interest payments and principal payments. That will give you the value of liabilities. And then find the present value of any money that investors will get, the equity investors will get. That's the dividends and stock repurchases. So these two will help value equity. Is this the only way? Not necessarily. This is a simplistic method. So that is it in terms of this reading. I'll just summarize the most important points. The first and perhaps most testable aspect of this reading is to come up with cash flows for different kinds of projects and to be able to show the impact of depreciation here. Remember, there are three categories of cash flows. The first is the initial outlay. And what I have shown here is the initial outlay for a replacement project, which is in a sense a superset, because if you just have a plain expansion project, then that is just a smaller part of this. With an expansion project, there is none of this business. Then the second part is the cash flow every year from operations. TD is the depreciation tax shield, and this is the terminal year non-operating cash flow. Make sure you know how to use these expressions. Then we talked about the impact of inflation. The core point is that this reduces the value of the depreciation tax shield. Compare projects with unequal lives. So we talked about the LCM approach and EAA approach. Point here is to put different projects on the same footing before you compare them. Then we talked about capital rationing, where you have a fixed budget and you need to pick projects that maximize NPV within that fixed budget. Sensitivity and scenario analysis. Very often your inputs cannot be predicted for sure. They are stochastic, they are random. So you can do sensitivity and scenario analysis that give you a sense for the standalone risk of a project. Real options allow you to model the impact of options that might be embedded in your projects. The curriculum has 2 or 3 examples which you should do. There was a slide on capital budgeting pitfalls, which were common sense items, so make sure you know those pitfalls. Understand the distinction between economic income and accounting income. Whenever you hear the term economic, that means that we are looking at the economic reality of what's going on. In this context, we look at economic depreciation or the change in economic value of an asset, and that needs to be incorporated into the income. And finally, economic profit. The formula for this was we take our NOPAT and then we subtract the dollar WACC. This takes the perspective of all shareholders. The residual income definition that we've taken in this particular reading is that for equity holders. When you study this in equity, then you will notice that in that particular reading, the residual income definition is for equity holders, and then there is also a definition for overall investors. And then claims valuation means that we value based on the right side of the balance sheet. As always, I want you to go over the summary, review the learning objectives. There are not that many examples, but that is more than compensated by the practice problems. Lots of practice problems, which is very good. Practice them. I don't think it will really be necessary here, but if you are eager, you can also look at practice questions from other sources.